Are you trying to purchase your next investment property, but maybe the banks told you, sorry, you don't qualify, you don't make enough income, you don't meet the debt-to-income requirements? Well, you are in the right place. On today's episode, we're going to go over how to use the free DSCR calculator located on the SCI Mortgage website to see if your next property debt coverage is to qualify for financing with no income documentation and no debt-to-income requirements. Let's get into it. Welcome back to another episode. I'm grateful for everyone in the community of self-employed and property investors, and hopefully you'll get a lot out of this very simple, easy to use tool in order to see if your next property debt coverage is in order to qualify for financing. So you're going to head over to the scimortgage.com website, and from there you're going to click on the Tools and Resources tab, select the DSCR calculator. So what is a debt service coverage ratio loan? Well, essentially what that means is you're going to take what your net operating income is divided by your total monthly mortgage payment, including taxes, insurance, and any HOAs, and that will give you a percentage whether the property debt coverages or not. Typically, what the investor is looking for is a 1-to-1 debt coverage. Your mortgage payment with all taxes and insurance equals the same amount of what you're renting the property for. The good news is when you use the DSCR loan, we are going to use 100% of the rental income versus a traditional conventional conforming QM loan where they're only going to use 75% of the rent when buying a new property based on whether you have a signed executed lease agreement with first month's rent and deposit or using comparables from the appraisal and taking the middle of the average rent. This method is still used when qualifying for a debt coverage loan. However, that average rent received from the rental appraisal, we will use 100% of that. So for our purposes, let's jump into the income and expenses per month. So if you're on the tool, let's just say our rent is $3,000 a month, and right underneath that, you're going to see vacancy and credit loss. So for the debt coverage loan, we can leave this at 0, meaning that the total rent that you receive, which is estimated at $3,000 for this example, we are going to use 100% of that. Then the only thing you need in order to determine your debt coverage is what does the payment total. So for our purposes, let's say you have a loan of $250,000. It is on a regular 30-year fixed with an interest rate of 6.5%. Your monthly taxes are around $350, and you have a monthly homeowner's insurance of $125. One thing to quickly point out is you need to take into consideration that the homeowner's insurance is going to be higher than it would be if you own a primary residence because you have to carry rental insurance, rent loss coverage. There's different risks involved because this is an investment property. So it can't hurt if you're using this calculator and you have a property in mind, get a few quotes from the insurance company to see how that pencils out so you can make sure that you're going into this transaction knowing that you're already going to debt coverage. And then finally, if the property does have any homeowners association dues, you're going to enter that figure. For our example purposes, let's say this was a single family. So once you go over to the right-hand side, you'll see the results. The effective gross income is $3,000. We have 0 for recurring operating expenses, giving us a net rental income of $3,000. Right underneath, it's showing us that this property debt coverage is 1.46%, meaning that not only does it coverage 1-to-1, but it's almost giving us a 1.5% debt coverage. So why that's important to note is the higher the property debt coverage is, the better the interest rate will be that you'll receive from the investor. However, let's say the property only makes $2,000 a month in income, you would be at a debt coverage of 0.97, which is just under 1%. So typically, the majority of investors that we work with require at least a 1-to-1 debt coverage based on a down payment of as low as 15%. However, if you have additional funds available and you still want to utilize this no income doc, no debt to income ratio program, you can put a 25% down payment and have a no ratio. So what that means is when you're looking at this example, this 0.97 is below a 1, which doesn't matter. So when you're looking at this example and it's only a 0.97 debt coverage, it's not going to affect qualifying for financing because there is a no ratio requirement, meaning the property could debt coverage at 0.5 or 0, right? So let's say you're purchasing it, you don't quite have it rented yet, you want to do some work on the property to get it ready for fair market rent, you could utilize a 25% down payment. In addition to that, we've covered in other episodes, there's ways to use assets in order to turn it into income to debt coverage, which would put you above the no ratio limit, giving you better financing options. So feel free to check that out. That's it. It's pretty straightforward. Now that you're empowered with the DSCR calculator tool, you can make sure your next potential investment property is a winner before ever making an offer. And if you're looking to qualify for this type of financing, we'd love the opportunity to connect with you and pencil out your next deal. Feel free to head over to sceimortgage.com for other great tools and resources. And thank you so much for being a part of the community. And remember to let your income work smarter, not harder. We'll see you on the next one.